The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 4 September 2020. Well, I'd like to start off the stock market, so let me start there. On Thursday, the NASDAQ was leading the market lower, and it was the worst drop since June 11th. A lot of negative sentiment out there, and the relative strength indicator was dropping rapidly, and it could be an indicator of things to come. However, the market's still at a very high level and overvalued. The volume on the sell side on Thursday was extreme relative to what it's been the last 6 months. And that is also a warning. Price and volume are, of course, key indicators. However, on Friday, as I'm doing this weekly perspective, the job reports actually gave a boost to bond yields. And the jobs report saw a bigger than expected jump in non-farm payrolls during August and a bigger than expected drop in unemployment. That strong combination helped the rebound in bond yields. Financials were also stronger on the day, as well as banks. And I'm just going to leave it there for the stock market. Obviously, my fundamental take is that it's overvalued almost across the board. However, it can be irrational for a very long time, as most of us know. Just a brief note that I'm starting to do something a little different on the blog. This is the blog page from our landing page, themorganreport.com. Pull down the blog menu, and this is where you go. As I've said in the past, this nav bar way at the top is kind of hard to see. It's very top. It links to our YouTube channel, our Twitter feed, our LinkedIn presence, corporate presence on Facebook, and the site map. And for those that are premium members, paid members, we are probably going to have to take the site down for a few hours. There's never a convenient time to do it, especially since we publish this weekend. But we've kind of outgrown our server, and our server is very own. Yes, I own my own server. However, none of this stuff is forever. So unfortunately, we're going to have to do some maintenance. And again, unfortunately, it's probably going to be in a weekend where we publish. I'm going to do my best to maintain what we have and have had for years and years on the present server until people have had a chance to log in, get the report, either download the PDF or print it out or both, and then move on. And we're doing the best we can. I just want to give you a heads up on that. First article up from MarketWatch, PMI data shows near stalling of Eurozone service sector in August. The Purchasing Managers Index is a very good indicator, and basically this says that, as the headline, not much is going on. Economic activity, I wouldn't say at a standstill, but nearly so. You can see the Eurozone Composite PMI, and it just basically fell off a cliff during this CV situation. So, small article, you can read it in 2 minutes. Let's move on. I want to expand on that from the Eurozone into the global zone. So this is the Baltic Dry Index. If you're not familiar with it, you can look it up. It's an economic indicator issued daily by the London-based Baltic Exchange, not restricted to Baltic Sea countries. The index provides an assessment of the price of moving the major raw materials by sea. In other words, most goods don't come by air, they come by sea. And a lot of activity in the Baltic Dry Index means a lot of goods are moving from place to place. And if it's low, it means there is little goods moving across the oceans. And that's been the case. So you can see the 1 year period here, and you can see where we've got the CV coming into the 4 in March. You can see how low it is. And then you can also see what it looks like on an annual basis in this lower graph, where it went from a rather robust move from the early 2000s, 2003 or so, all the way through 2008, before the big 2008 financial crisis. And since that time, it's bounced up to 4,000 on the index, down to where it is now. And what I want to point out is, as I've said, probably from the time I instituted the weekly perspective, which hasn't been that long. I didn't even know it's been a couple years, but I've constantly forecast, or really not even forecast, just showed the evidence that we were in a contraction, that goods were not as robust as previous times, And this just shows that basically from the financial crisis, we never really recovered from a physical economy standpoint, notwithstanding what the NASDAQ number is or the S&P number is or the Dow number is or what the currency fluctuations are. The physical economy has been deteriorating, and it's rapidly deteriorating since CB entered into the picture. So next up is straight from Reuters. U.S. trade deficit jumps to a 12-year high in July. The U.S. trade deficit surged to its highest level since 2008 in July amid a record increase in imports, suggesting that trade could be a drag on economic growth in the third quarter. The Commerce Department said on Thursday the trade deficit jumped almost 19% to $63.6 billion, the highest since July 2008. Imports soared by a historic 11% to $231.7 billion. Goods imports vaulted to 12.3% to $196.4 billion, and exports increased 8.1% to $168 billion. Goods exports rose 11.9% to $115 billion. Probably didn't need all of those numbers. I want to point out something that some of you, especially those that follow my work and others, know, but many of you probably don't know, and that's the Triffin paradox. And the Triffin dilemma or Triffin paradox is a conflict of economic interests that arises between short-term domestic and long-term international objectives for countries whose currencies serve as the global reserve currency. Well, what's that? That's the U.S. dollar. So here's the U.S. going into a larger trade deficit that I just went over. The dilemma was identified in the 1960s by Robert Triffin, who pointed out that the country whose currency being the global reserve currency foreign nations wish to hold must be willing to supply the world with an extra supply of its currency to fulfill world demand for these foreign exchange reserves, thus leading to a trade deficit. So in plain English, the U.S. has to maintain a large deficit and basically ever-increasing deficit for world trade to continue. And very few people even talk about it. I hope you understood it. If you don't, look up Triffin, Triffin, dilemma, and do a little bit of study this weekend. But we are in the last throes of the great Keynesian experiment, the great fiat fiasco, the print yourself wealthy experiment, and they always end badly, and this one will as well. And many of you are already there, and I really do feel for you. I know how many have been laid off in the United States and the world, and that many will have basically no chance of getting their old job back and have to basically fend for themselves. I also know that the U.S. as a whole has underrated the ability to save or the wish to save, or basically the fact is that there's very low savings rate among most Americans, which makes the matters even worse. The old saving for a rainy day came kind of passe. If you could get it on credit, buy it now, enjoy it now, and pay for it later. And that's really a poor attitude in the long run, especially if you have a contraction, which we're now experiencing. So this is over. All my friends, I don't think they wrote it, but maybe they did. Pension funds start looking to gold to avert disaster. This is Money Metals Exchange. I do know the owners, and I do podcast with them from time to time. It's one of the dealers that I do recommend, so just in case you're wondering, full disclosure on that, I believe. So let's get into this. Public and private pension funds face a dual crisis. The first and most obvious threat to pensioners is the defined benefits vehicles that are severely underfunded. By one estimate, pension systems taken as a whole are $638 billion in the red. That means that they don't have that money, and they need it in order to fulfill their obligations. Some are in better shape fiscally than others. The Fed declares war on savers. The Federal Reserve has been effectively declared war on savers by vowing to hold short-term interest rates near zero, likely for years to come. Longer-term bond yields also plummeted to record lows below 1% for most maturities this year. Interest rates down, bond prices up. This game of playing the bond is going to end, and it's going to end badly in my view. And once it does, that's sort of the final nail in the coffin as a metaphor, because everything really revolves around the credit markets, and interest rates have been maintained into the level that the powers that be wish them to. It's called financial repression, and it's basically at the expense of the people for the enrichment of the elite, the banks, and governments in order to be able to pay back the money that the government owes the banking system. Because if the interest rates are low, your payment back is low. If interest rates go high, then what you owe on a monthly basis is far higher. So anyway, back to the article. Pension plans can hold gold, but only these two do. Last week, Ohio's $16 billion police and fire pension fund approved a 5% allocation of the monetary metal. This relatively small gold allocation provides at least some measure of portfolio diversification and could pay off in outsized way if the gold market enters into a price compounding mania phase. And I've been on record many times stating that I believe this is going to take place, because when the bond or credit debt markets blow up, you're going to see that spill over in the stock market, which will take up care of a lot of the real estate market, which is happening now. Commercial real estate is not doing well on aggregate. Yes, there are probably a few areas here and there, but you can probably get a good deal buying a shopping mall right now if you want. But who wants one? Everyone's shopping offline. No one's going, doing much interface. I mean, a lot of things have changed since the CV situation. And to me, it's valid, but overblown, and maybe partially or more than partially a excuse, red herring, flag, whatever, to the real economic system breaking apart. So anyway, back onto the article. Ohio joins the teachers' retirement system, and having been the only two known public pension programs to hold precious metals. So this is kind of a precursor for what's going to happen. The run to gold starts slowly. It's one pension fund, then two, then 5, then 10, then 15, then 25, then 50, then 75, and on it goes. That's what usually happens. And when it gets to the mania phase, you're not going to be able to get in, I don't think. So read this. It's from Stephen Gleason. He and I have known each other for years. I respect his opinions, his writing ability, and we have worked together in the past and probably will in the future. All right, as I said earlier, this is publishing weekend for the Morgan Report. This is the September issue. This is the rough draft. This isn't actually what it looks like when it's fully published. It's in let's say a prettier or nicer format, but the information's the same, but it's edited for everything, grammar and punctuation and spelling, of course. So I usually start with a quote, and this time I quoted myself, which I seldom do, so please keep that in mind. But this quote was early on in the bull market of the precious metals when they started. And I said, for the record, I will state that there will be another more frenzied scramble, which will carry silver prices to highs that will repair all the excess paper money creation, price suppression, supply deficit, and bearish sentiment over the past 2 decades. Got to remember, at that time, it was 2002, so I was talking about, the 20 years where silver was basically in a bear market. This will become known as the Great Silver Crisis. So, as I said, I seldom quote myself. Before diving into the big picture, I talked about what's going on with the CDC, the biggest news about really how much of this accounting was actually due to COVID and wasn't double counted or some other thing. Talked about the Coinbase chief legal officer, Brian Brooks, being reassigned to the Treasury Department. I think this is extremely important. I'm 99% sure that we're going to go to a digital currency globally, and of course the U.S. will probably have what some have referred to as the Fed coin. I talked a bit about these banking systems that are changing rapidly. And I talked about food as it continues to be a major situation for basically everyone, although you might not be aware of it yet. You will be within a year, probably less. So I'm going to wrap it up there, try to keep these at 15 minutes or less. It's easy for me to talk that long. And I do want to reiterate for everyone that you can go to themorganreport.com, get on our free email list. You will get all the interviews and the weekly perspective that I do each week. And also other things, offers that come occasionally, that type of thing. Most people are pretty happy with the free information. Of course, if you care to move up from there into the premium service, then certainly you are welcome to do so. I'll sign off, as always, that there's nothing more powerful than the truth. We are facing the most interesting of times ahead. Many people are distraught already. And in my studied view, it is going to continue on that trend for some time. So if you're not prepared, as Greg Hunter says every week, be prepared physically, mentally, and most of all spiritually. We are entering some interesting times, and it pays to be grounded, solid, kind, and sincere. There's more to life than money, and there's a lot that we have unlearned and probably need to reestablish. Unfortunately, in my view and my perspective, it's going to be a rather rough road for many, many people. So if you have the means, the heart, the will to help others, if you are blessed with more, it would be my sincere wish that those people are willing to reach out to their brethren. I'll leave it there this week. I'll be back with you next week with another weekly perspective.